Hi and welcome to this channel. Here we discuss mostly topics on treasury, asset and liability management, banking, finance in general. And today we're going to talk about a topic on liquidity risk and why it's so important for banks to maintain control on liquidity risk. And first we need to describe what is liquidity. And liquidity in general is the ability to convert assets or convert things into cash and fast. So let me give you an example. Let's say that you want to sell your house tomorrow. Can you do that? It's super hard, right? You need to find a buyer, you need to show the house around, you may need to find a lawyer, you may need to find an actuary, you may need to, let's say that you have everything sorted out, you still need to wait for the cash to come in. It's super difficult, it takes a lot of time. Let's say that you want to sell your guitar and your guitar is worth $5,000 but you want to sell it tomorrow. You go to a second-hand dealer and they offer you much less, maybe 4,000, maybe less, because you want it fast, right? So that's what you need to lose, right? But now let's say that you have a check. Someone writes you a check. It's a piece of paper, it's a document that you can go into the bank and then you can cash out. And you can cash out today if it's still like opening hours, or you can cash it tomorrow. But it's super fast. It's just a piece of paper. It's not money, it's not cash, but you can convert it into cash very easy. That is what liquidity is looking for. Instruments, financial assets that are easily converted into cash and fast. Obviously cash is the main one, but you have others like notes, bonds, corporate bonds, government bonds of high quality. Those are the things that we think when we think about liquidity. And when we think about liquidity, we also need to think about Basel. We also need to think about banking regulation. And Basel basically is a committee that regulates or basically overviews all the banking supervision and sets some standards on how banks are expected to monitor and manage the liquidity. But what we're going to discuss here is a little bit more of an introduction of what is Basel, what is the liquidity requirements that banks are subject to, and most importantly, why the banks are required to do this, why banks are so encouraged to monitor the liquidity levels. So let me go to the website so I can show you a little bit more of what is Basel. Now, if we go to this website, the Bank of International Settlements, and you go to the Committees and Associations section about the BCBS. BCBS stands for Basel Committee on Banking Supervision, and as the name suggests, it's a committee for banking supervision, and members are mostly regulators from different countries, from different jurisdictions. The committee started many years ago and it has grown to so many members today, but today in 2026 I don't know exactly how many countries there are, but we are talking about at least 28 jurisdictions today. And if we dive in a little bit more, the Basel Committee, initially named the Committee on Banking Regulations and Supervisory Practices, was established by the central bank governors of the group of 10 countries at the end of 1974, in the aftermath of serious disturbances in international currency and banking markets, notably the failure of Bankhaus Herstatt in West Germany. And this committee was established to enhance financial stability by improving the quality of banking supervision worldwide. So in general, the banking supervision is not only to supervise banks, but also to regulate them, to dictate how they should operate and what kind of safeguards we as clients need to have. And whenever you hear about Basel, you will basically think about this, and there has been like a construction of different stages of Basel. There were different accords or agreements between the different members of the committee to have, for example, Basel I was the first one, Basel Capital Accord, then Basel II, the new capital framework, and lastly, the one that we still have today, Basel III, responding to the 2007 to 2009 financial crisis. So over time, this has evolved with different level of requirements. I'm not going to the details, but you can read a little bit here. Basel I was basically the first accord that came into effect, and this was basically, let's read, with the foundations of supervision of internationally active banks. Capital adequacy soon became the main focus of the committee's activities. In the early 80s, the onset of the Latin American debt crisis heightened the committee's concerns that the capital ratios of the main international banks were deteriorating at a time of growing international risks. Backed by the G10 governors, committee members resolved to halt the erosion of capital standards in the banking systems, and they resulted in a broad consensus on weighted approach to measurement of risk, both on and off banks' balance sheets. And in summary, what they did is they basically require a minimum ratio of capital to risk-weighted assets of 8% to be implemented by the end of 1992. What happened is, well, the countries in this, at this time, the 10 countries that were part of this, they implemented locally on their jurisdictions this requirement. And what this means is banks need to have capital, and they need to have enough banks need to have basically capital in proportion to the risk they take. So if banks have let's say 10 million of risky assets, they at least need to have 8% of that in their capital, in the equity. Now, why this is so important? Because generally speaking, banks are super leveraged. Banks, stakeholders, mostly the shareholders, the equity owners of the bank, will rarely originate loans from their money. That doesn't happen. How banks operate is banks establish with an equity investment, and that probably can represent 10, 20, 25% of the total balance sheet size. The remaining part is coming from the depositors, you, me, borrowings, affiliates, money, debt. So the liabilities is super big, and then they take that money and they invest that money into cash. They construct the bank, obviously, and then they start to originate loans, credit card loans, personal loans. They also create mortgage loans. So they take the money from clients like you and me, they put it in a pool, they put it everything like in a pool of funds, and then they make loans with that. And the interest rate that they charge between these two different sides is how they make money. They obviously also charge fees and other types of revenue generators, but mostly interest between what they charge versus what they pay is how they make money. So obviously the lesser the capital, the less capital in the bank is, the bigger the returns for the shareholders, and eventually the bank, that's how it makes money. So banks are super motivated to have lower levels of capital. So because of this, Basel enter, and they basically try to require banks to hold more capital in their balance sheets to compensate for those additional risks that they are taking. Banks are taking risk because banks, when they lend money, when they make a loan, they take a credit risk because they may not be paid back. Now, whenever they have excess cash, so basically they cannot invest, they cannot put everything into loans. That excess cash needs to go somewhere, and they will not put it just anywhere. Banks will invest excess cash in securities, or they will operate trading for customers or and clients, and those trading activities will generate P&L, basically profit and loss. That is also a market risk because the market is moving constantly, right? That can create losses for the bank, so that creates that risk. And then you also have operational risk, so banks can be subject to basically fraud, they can be subject to hackers, they can be subject to employee mistakes or internal fraud. So there are too many operational risks. So basically these Basel Accords are in a way punishing banks to have more capital the more risk they take. So the equation is very simple: the more risky assets you have, the more as a percentage you need to hold in capital. But going back to the website here, Basel II new capital framework added a little bit more requirements. I'm not going to details. The important one is Basel III, because Basel III was a response to the 2007 to 09 financial crisis. During the global financial crisis, there was a big issue with liquidity worldwide. So what banks established at the moment was, well, they were investing so heavily in financial instruments that were too risky, that probably were not transparent enough. The instruments were qualified as high quality, but in fact they were actually very risky and they were basically garbage. So these financial instruments eventually were worth nothing, and banks didn't have the liquidity they thought they had. And when bank runs happened, when clients were withdrawing their money, when creditors were asking their money back, they couldn't pay back, and that's how some banks eventually failed. And as liquidity was one of the main problems during the crisis back then, the Basel Committee, besides establishing additional capital buffers in Basel III, they also introduced liquidity requirements. And they said here a minimum liquidity ratio called Liquidity Coverage Ratio, LCR, is intended to provide enough cash to cover funding needs over a 30-day period of stress. And on a longer term ratio, the net stable funding ratio, NSFR, is intended to address maturity mismatches over the entire balance sheet. So going more deeply on liquidity, as we just saw, the liquidity coverage ratio is a requirement whereby banks are supposedly required to hold enough liquid assets or cash to cover for all the outflows and expected obligations coming due in the next 30 days. That is the LCR, and that is very similar to the accounting ratios that maybe you're familiar with, where we compare current assets with current liabilities. We should be able to cover most of the, or if not fully cover, the current liabilities with the current assets. There is also a financial ratio called the quick ratio, where most companies will measure cash and cash equivalents plus accounts receivable divided by current liabilities. And the point is that companies should have enough short-term and liquid assets to cover for their short-term liabilities. And this is a little similar to that. Banks are actually measuring that in a 30-day bucket. So what this means is banks also account for what is liquid and what instruments, financial instruments or assets, are high quality and are liquid, so that we can convert that into cash easily and fast to meet the obligations for the next 30 days. So we introduce now the concept of HQLA. HQLA stands for high quality liquid assets, and it basically contains all the assets that could be sold easily and they are highly liquid, such as treasury bills, bonds from governments such as the US, Germany, Japan. There are also like a tier of different categories of governments, depending on which government the bond comes from. that is going to be the qualifier that it gets, and how high quality is. Corporate bonds are also in the equation, but certain corporate bonds with certain credit ratings only, and you will also have supranational bonds as well. So the idea is that any bond financial instrument that can be converted into cash is form of the HQLAs, and there is a list, there is a tier. I'm putting here on the screen what is the categorization of HQLAs. So cash plus this instruments are the pool of HQLAs, or basically assets that are easily converted into cash and that can be converted fast. Now, because we are assuming that we are going to sell the securities super fast, we may also assume there is a haircut. That means we will not get the full amount that we have as the market value of that instrument. Let's say you have a corporate bond from X company that is high quality and it's worth 10 million US dollars in the market. That's the market value. But once you go to sell it and you want to sell it tomorrow, maybe you need to take a haircut. That means you will get paid much less, probably 9%, 5% less of what the face value of that instrument is, or the market value of that instrument. And that is because you want to sell it, and that is because you want the cash fast. So you need to take some losses. So that is the price of selling when you are in need, right? When you urgently need the cash. On the top we have the HQLAs, and in the denominator we have the net outflows. Why net? Because you can still have inflows. So the idea is that you have scheduled inflows that you know are happening because you have a contract, because there are contractual inflows, contractual cash flows happening in the next 30 days. But you also have contractual obligations. You have contractual debt. You have salaries that banks need to pay, salaries as well. They have outflows that are clearly scheduled, and also some deposits are time deposits that are maturing in the next few days or in the next 30 days that are included, and also non-stable or non-core so-called volatile deposits. So current and savings accounts are usually considered long-term, or they have some behavioral assumptions. There is a portion that is considered volatile or non-core that is considered to go in the overnight tenor. So that is considered that the clients will withdraw that money with some certainty. So that is included in those outflows. So once you account for what you can experience in the next 30 days as outflows, then you should be able to cover with your current HQLAs, you should be able to cover for those obligations. So the requirement is usually to have 100% coverage of your obligations in the next 30 days. If you don't have that, then you're in serious trouble. What can happen is the regulator may come and visit you, and they can scrutinize your books, your management. They can even require you to take actions, or they can even take over the bank, and they take control of the bank to make some security for the financial system, that the bank is going to remain afloat. And that is why in practice, for risk management practices, banks establish different metrics like early warnings, triggers, limits. So instead of monitoring at the 100%, you are monitoring as a bank, you're monitoring at the 120%. So in case your liquidity levels drop below 120, you still have some buffer, some time to react. So they set a limit. Okay, my internal limit is 120. That means if the liquidity levels go below 120, then they need to escalate that to the Asset Liability Committee or any meaningful board, and the treasurer or whoever is responsible needs to document and present a dedicated plan, a playbook of actions that they will need to do to replenish liquidity before the bank gets close to the 100, because they don't want to get close to the 100. Now for NSFR, NSFR has a little more complicated view. Before we think about current assets, current liabilities, but in a much shorter time frame 30 days. When we think about NSFR, we're thinking in the long term, at least 1 year. It's a 1 year liquidity metric. But in this case, we are flipping, and instead we're looking at liabilities over assets. And how it looks like is like this: NSFR is equal to available stable funding divided by required stable funding. The required stable funding is your assets. Let's say the required funding for a mortgage loan. That is a required funding. You need to fund that mortgage. Now, the available stable funding, when we hear about the stable, we're thinking about long term. So a stable that is obviously high, considered high quality, that is the funding that comes from capital, from the equity, from the liabilities for long-term borrowings. So the idea behind this metric is that banks do not over rely on short-term borrowing, because what is happening sometimes is that banks will they will originate a mortgage loan that is 25 years tenor with a short-term borrowing. So they fund the mortgage of 25 years with a short-term borrowing of 2 days. So that doesn't really make any sense, right? Because you have a borrowing of 2 days and then you use that to fund a mortgage loan of 25 years. That creates an interest rate risk, but we are not talking about that here. But what happens is, what if the conditions of the short-term liability, the funding, change? What if they don't want to lend to you anymore? Then you don't have the funding for this loan anymore, and that is a huge problem. So why banks do it? Because financially, the interest rates they need to pay, the cost of funds for the short-term borrowing, because it's short-term, is supposed to be lower when the yield curve is it's like a steep yield curve. So if it's like a normal yield curve, an upward sloping yield curve, then that means in the short-term tenors the interest rate is low, but in the long-term tenors the interest rate is high. So what banks do is, they borrow cheap and then they charge a higher interest rate on the mortgage loans, and then they earn money. And because it's a long-term asset, it creates more profits, because the interest they earn on the assets are far bigger than the interest risk that they get on the liabilities. But if the yield curve inverts, which has happened especially during COVID and many other past events, if the yield curve is inverted, which means the short-term interest rates are higher than the long-term interest rates, that is a huge problem now, because the mortgage loans are, let's say, lower interest rates and your funding is much higher because you are in the short term. So that creates a financial problem. And something similar happened to Silicon Valley Bank, where they didn't have the same duration in their assets and liabilities. But also, this funding gap between short term and long term should not ideally happen if you want to keep a safe bank, not just making profit, but a safe bank. So what the regulators came is with this equation, this metric that they need to meet. So when we think about available stable funding, that is long-term borrowings that are high quality, borrowings that account for as stable and that are on the long term. They need to cover for required stable funding. That's the required funding for long-term assets. So your long-term liabilities should match your long-term assets. That is essentially, in a very super oversimplified way to speak, what is NSFR trying to do, just to make sure that everything on the long term is matched in the liquidity terms, and the LCR is trying to do the same on the short-term tenors. And just to recap, banks are required to maintain minimum levels of liquidity after what happened And just to recap, so banks are required to hold minimum levels of liquidity that are acceptable levels of liquidity, prudent levels of liquidity, because of what happened in the global financial crisis in 2008. And because there are banking supervisory regulations and guidelines such as Basel III that many jurisdictions have implemented locally, and as such, banks operating in such countries need to comply with those Basel requirements, those Basel rules. Some of them are mostly focused on capital requirements, but with that it also comes the liquidity requirement, and liquidity is essential for operating a business like a bank, because if you don't have the money, if you don't have enough instruments or assets that can be converted into cash in case there is an emergency, there is going to be a problem in the future. So that's why banks are required to have these minimum levels of liquidity. In the next few videos, we are going to dive deep much more on how liquidity is managed, how liquidity is established, how liquidity metrics are established, how liquidity metrics are monitored, and more importantly, how all of this played out in the long term.